Good afternoon, ladies and gentlemen, and welcome to the Velocity Composites plc interim results investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted any time via the Q&A tab situated in the right-hand corner of your screen. Simply click on Q&A, type in your question, and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard. You'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Andy Beedon, Non-Executive Chairman, John Bridges, CEO, and Christopher Williams, Group FD of Velocity Composites plc. Good afternoon.
Presentation. Those familiar with the company will follow the usual format. And so first of all, I'd like to hand you over to Andy, who'll take you through some of the highlights.
Thank you, John. Welcome, everyone. The key things that I want to highlight to investors and to potential investors is some of the strategic achievements and milestones that have been executed in the last 6 months. We all know that the COVID pandemic has had a major impact on the volumes of the contracts that we have and of the build rates within the aerospace industry. But that doesn't mean that we've lost any actual customers. In fact, we are actually processing more parts today than we were 12 months ago in terms of complexity. It's simply the volume of those parts has reduced. And some of the key milestones that have been achieved is all our major contracts, which we had 3 major large customers, have been renewed on at least a 3-year basis going forward in this period, all with potentials of additional years to be added, all with either actual opportunities or potential opportunities for expansion of parts and sales over the next 3 years. So, for example, one of those 3 key contracts, we did about 75% of their UK kitting work, and the new contract, as it kicks in now for the second half of the year, we'll be doing 100%. So this is a key major milestone that underpins the opportunity for recovery and actual growth on top of recovery over the next several years. And on top of that, as a 4th point, which is the second bullet point here, is that we've achieved F35 approval, meaning that we can now start to break in meaningfully into the defence industry, starting in the UK, but also targeting the USA as well. And again, this is not something that should be taken lightly. We have had to work very hard to achieve this approval, and we are working directly with the main OEM in the UK for that program. And that OEM has several other key defence programs that we will be working on as well over time. And the difference between the defence contracts and the civil aviation contracts is that the defence contractor was focused on our service and our technology way before any view of efficiency or pricing or material saving. Their focus ultimately and initially is on the quality and the service and the digitalization of the front end of their composite facilities. And in that, this is a different type of contract commercially than the other contracts. So it is focused on us really charging for our engineering and process services and technology directly, rather than a buy-sell on material. And as such, it has a higher margin. And so if you then look at the margin in the half year, despite all the pressures, despite the fact that, we have the volume pressure, and we've had to rationalize the shop floor as well as the staff at Velocity, we've actually improved our margin from just over 20% to 25%. And the two reasons for that, one is our technology and our processing has improved efficiency, which is both benefiting us and our customers, and underpinned the fact that the customers therefore wanted to renew those contracts. And second, that we are selling our processes and technology at a higher margin through the defence contract rather than doing purely a material sell. And we expect that margin to improve further in the next 6 months as more of our business is going through that diversification. And therefore, we have a very strong pipeline for growth. The growth is now got various stages. There is the recovery phase of COVID. If you remember, we were on these contracts that we had running at just over 20 million of sales. They're now only worth about 8 million. And there's significant upside therefore over the next couple of years as we recover out of this phase. There is then the extra business that we have won, which at the moment is at a lot lower volume, but has the opportunity to also expand out. And then there are the key projects that we are still working on, one of which is expanding our relationship with defence contractors in the UK, and the other is expanding into the US, which has had to be put on hold because of travel and other restrictions, but has now been really reinitiated in the last month. Underpinning all that has been a very strong control over cash, cost reduction, which means we still have net cash, net after debt, on the balance sheet, having gone through the pandemic, which means we have a strong position in terms of investing out of the situation and into the future. And on top of that, we've even secured more funding through Close Brothers, which is, in no way a distressed form of funding. That relationship with Close Brothers is quite important to us strategically long term, because as we look to expand in the States and elsewhere and expand through the selling of our technology, we can see a time when we will be putting our kit, our automated kit and automated technology into customers' factories. And we wanted a partner that could help finance that through the contracts so that it became more compelling to the customers. So an important strategic move there for us. So I'm going to hand over to John, who's going to do a deeper dive into the market itself. And then Chris is going to cover the financials for the last 6 months. As we already said, there is an opportunity for Q&A. We usually get more questions than we can answer in the period, but we will fill out the ones that we don't have time on. But as I repeat, really, and the key message, yes, at the moment, volumes are much lower. However, this business still has plenty of cash in its balance sheet. It has reduced its operational costs. It is improving its margins, which means that as those volumes and sales come back, they're going to come back at a higher margin, and the break-even point of the business has been halved. So, there is very significant forward opportunities now to move back into profitability. And we are forecasting in the second half of this year that the EBITDA will be back to at least break even. If you look, the second half of last year, which was in the depths of COVID, we lost 1.3 million at EBITDA level. First half of this year, it was 0.6. Second half of this year, we expect it to be 0, and then we target a long-term move into profitability. So I'll hand you over to John now.
Thanks, Andy. So picking up there, as Andy said, on the market outlook, I think the phrase cautious optimism sits very well with what we're seeing at the moment. It's been obviously an incredibly difficult time for everyone, not just ourselves, of course, but our customers and ultimately our suppliers as well. The whole industry has been impacted, but we are starting to see some, let's say, shoots of recovery, which gives us a lot more optimistic approach to the future. So, you know, as we've spoken before, we're very fortunate in the sort of raw data for our industry is very public. So in terms of the primes like Airbus and Boeing, they have, you know, very clear public information around their market expectations. And we saw recently a slight increase in production rates from Airbus starting in 2022, which is the first one to really lift the production rates from the sort of minimum values that we've seen over the last 12-18 months. We are expecting that recovery to differ depending on the platform and the market segment, and there's a slide coming up where we go into a bit more detail there. But anywhere over the next 2 to 5 years from the start of the pandemic is when we're expecting to see that recovery really bite. There's also some encouraging news over the last few days as well. You probably saw on United Airlines placing quite a large order for new aircraft. And again, this is other signs that the industry, the wider industry, is starting to plan for the recovery and plan for, you know, the post-COVID era. As Andy said, why that makes us well placed. Well, clearly we've survived a very difficult period, and we've done a lot of work during that period to, as mentioned, to get that break-even point down to currently the 12 million. I think we're around 13.5 million at the full year mark. That journey continues, and, you know, really using all the improvements that we've done within the business, the technology improvements to help drive our own you know, profitability, hopefully, you know, sits really well as that moves forward into expanding the service to customers as well, and we'll talk about that in a couple of slides as well. Obviously, the key milestone was contracting customers, and again, that wasn't an easy activity. You can imagine the disruption across the whole industry. But again, we worked very hard with customers. We'd had the relationships in place, but again, people needed something different as they responded to COVID, and, you know, reduced the staffing levels at their sites, and, you know, we saw the same volume reductions through their production areas as well. So again, a lot of the technology developments that we'd brought forward and utilised ourselves allowed us to put an even more compelling proposition to customers, while still improving our margins as well. So that technology is key not only for ourselves, but also the customer proposition. And that technology continues to be developed. We've got another, you know, important 6 months ahead of us and beyond as we further improve that. And it's really about taking what is the industry problem, if you like, of, you know, very expensive materials, very long lead times, demand changes, optimizing, you know, customers' utilization of the products and the follow-on use of the products through into their facilities, and taking that whole numerical puzzle and developing, you know, very good, strong digital technology to help manage that, and to manage it in real time using a lot of Industry 4 technology. And as Andy touched on as well, a lot of, you know, very innovative digital manufacturing to make sure that the products we make, you know, that data is fed back to the system in real time to allow us to make the decisions to drive that efficiency, and also help our customers by being able to respond to any changes, to any hopefully now a lot more rate increases, and manage that through the whole you know, 6 month plus material lead time supply chain. So it's proving very useful for us. We've seen the effects of that technology development, and again, as coming up, we'll talk about a slide where we can take that forward into enhanced proposition for customers. And then clearly underpinning all that is the liquidity position, which Chris and the team have managed very well, and, you know, the whole business is supported in terms of making sure that we maintain that liquidity through these what have been quite difficult periods, but also obviously with an eye on the recovery to make sure, you know, we can manage the recovery with things like material lead times and costs as we support the industry through that recovery. The next slide, as we discussed, talks a little bit about how we see the industry recover. And again, it's difficult when there's a lot of public information out there. Everyone's got different opinions, and it'll become a lot clearer as air travel unlocks, and people are allowed to take much more international journeys. But essentially, we can see three clear segments of recovery. You've got the sort of single aisle, the A320, the 737 type aircraft, and now the A220. We're seeing probably much more confidence around a rapid recovery on those platforms. Again, supported by the recent announcement from United and other airlines, where they look to build their fleets back stronger, having taken a lot of capacity out of the global fleet through the pandemic. The next segment is the wide body, the sort of twin aisle aircraft, which are much more stronger adopters of all composite aircraft. So things, aircraft like the A350 and the 787 are pretty much all composite structures. But again, we're starting to see some noise of recovery and some expectations of rate improvements over certainly into 2023. But there's still a bit more uncertainty in the different sort of market analysis about when that comes back and how. And again, as we say, that the clarity there will come when international travel opens up properly and opens up permanently with some clear, longer term recovery there. And then the final sector, which Andy talked about previously, which we said at the sort of full year we were looking to diversify into, predominantly because there's good opportunity, but also the rates haven't been affected by COVID, is the defence sector. And again, we're not having to forecast a recovery because there's not been a reduction, but there is also some strong growth in platforms there as well, particularly about some of the key programs like F35. And again, these are all pretty much fully composite aircraft. These were the early adopters of composites, if you like, in the defence market. And we see strong opportunity there, and very sort of robust production volumes, even with things like COVID that comes along. The defence sector just hasn't been affected by the rate reductions there. So that's how we see the market. As we say, it's an ever-moving picture. There are lots more signs of recovery than there was at the full year. But again, we keep a close eye on this. It's a lot of public information, and as our platforms then feed into this, and then the things like stock at customers and end product stock feed through, we'll have a much clearer position on what that means to our demand from our customers over the next 6 months and beyond. Moving on to the model development, which we've mentioned. And again, this has been quite an interesting activity over the 6 months, obviously with limits on travel and limits on what we can achieve sort of out in the wider world. Obviously there's been a lot of focus internally and a lot of development internally, firstly to help us because this technology is what we're using at the moment internally. But then as we've developed that technology, it's really opened up a different opportunity on how we, a more flexible way on how we can utilize that technology in a different way to support customers post-COVID in a more flexible and a more sort of rapid deployment way. So as I say, this development's been made for our own benefits, and we've seen the benefits of that with our, the improved proposition to customers and the improved margin. And what this means really is taking all our key areas and developing a unified system which controls, manages, and utilizes the data from those systems in a real-time way. And that development's ongoing. It's not complete by any means yet, but we're starting to see and have seen the benefits. So previously, the model was really much based on 100% offload. So essentially, customers would take something that they're doing, we'd sort of onboard it into our facilities, we'd do it more efficiently, and then deliver the products back to the customer. That model works great, and that model will continue to work great for customers who we can serve with nearby facilities or have plans to serve with nearby facilities, but also customers who are space constrained and want to, remove these non-value added activities as they see them into someone's facilities who can manage them much better. What we found is, as we develop that technology further with some other developments to the technology, i.e. Putting in very simplistic terms, putting a front end on it and allow it to be sort of managed centrally but deployed externally. What that allows us to look at now is a different model where we can actually deploy that technology on site at customers. And again, there is no one sort of solution fits all. It really depends on that particular customer, their needs, their constraints, and their sort of use of their site going forward. But for some customers, it is very much attractive if we can take that technology, take our digital manufacturing hardware as well, and actually deploy it onto the site and actually deliver the service from the site, albeit controlled centrally and controlled by our teams. Or the third way there is a hybrid of both, where we can control the whole supply chain ourselves, but perform some of the manufacturing in our facilities and some of it on site at customers as well. And again, what that means is there's a complete flexibility on how we deploy the service. The actual end product is the same. The customer will still get those, super efficient, high quality kits just in time delivered to the site to allow them to start their manufacturing, all wrapped up in, a very data-driven, digital, continuous improvement environment. It just gives us the flexibility on how that is deployed and how that meets the customer's requirement. In the required time frame. So a lot of interesting development work continuing there. We're looking to have the pilot completed in the next 6 months, and we'll obviously update matters at the full year in January. But interesting, as we say, it's a lot of clever hardware and software solution, but it is all wrapped up in our team. So interesting development. We've benefited from the in-house version. And essentially what we're developing now is a licensable or deployable version that can be put out to customer sites to offer a very different way of delivering it, but the same quality, the same service, and the same commercial benefits for us and the customers as well. So very interesting development there. I'll hand you over now to Chris, who will take you through the financial summary.
Great. Thank you, John, and good afternoon, everyone. I think what I'd like to do is just take you through some of the financial highlights, some of the key numbers as we see them. So starting really with our revenue, our sales. So we've seen obviously a significant impact from the underlying build rates from the COVID pandemic. So typically last year, same period last year, we were at 9.5 million. We're currently at 4.4, which is 5.1 million lower than the same period last year. I think I guess there's probably a couple of things to note in that. So firstly, the same period last year had about 4.5 months of pre-COVID rates before lockdown really kicked in, and we saw the slump in demand. And then secondly, the kind of first half of this year, we did see quite a lot of customer closures November, December time, just as that the kind of second lockdown was kicking in, more so than normal. So there's two kind of slight anomalies in both those periods and the comparison really. But I think the positives that we've taken from it are that there's no customer losses in the half year just gone. In fact, quite the opposite. We've recontracted our 3 biggest customers, and that's securing a minimum of 8 million sales for the next 3 years is secured through those contracts, and that's at COVID production rates. So the hope is that the recovery will kick in and those rates will improve in time. And then also we've started to see a steady state come in from our sales demand now. So probably from about mid-January this year onwards, we've started to see sales plateau a little bit, and thankfully we've seen the bottom, we think, of the situation. And then just a couple of other points really on the sales point. So although they declined just over 5 million, we haven't seen that all fall through into our profit or loss, as the case may be. So typically at our old margins, at a 5 million sales loss, we'd have expected about a 1.1 million decline in profit or increase in the loss, and we haven't seen it to that extent. And indeed, we are looking into the next half of this year with a plan to break even at an adjusted EBITDA level for the second half of this year. And I'll come on to the kind of reasons why that is, and we've been pulling some of the levers that we've got available to us. From a margin perspective, I think Andy's already touched on this, but a lot of focus has gone into improving our margin position as something that we can influence, and that increase from 20.5% to 25.1% has really come from two areas. So the onboarding of the new military customer and a slightly different model, which doesn't have material in it and is primarily linked to labour, that has had a higher margin than our usual contract, and that's helped to boost it from a sales mix perspective. But I think probably the key point I'd like to flag is a good 2 percentage points of that increase has come from technological improvements within the business, and what we've done within the business, focusing on material savings and enhancing our technology, is we've actually managed to increase the material savings and benefits that we've seen, but also we've passed them on to customers as well. So there's actually more savings that we've realised there than is in the margin, and so the value offering of Velocity, we believe is enhanced as a result of that, and it's been time and investment well spent. From an operating loss and an EBITDA perspective, operating loss has increased 0.4 million to 1 million, and adjusted EBITDA has increased 0.3 million from 0.3 to 0.6 million. So although there are increased losses, given the sales decline, we've not seen that fall through to the bottom line, and the mitigations we've put in place have been around improving our margin and reducing our overhead base. We mentioned at the year end that we've been through a restructuring process. We've successfully year on year taken out 1.3 million from our overhead base, and work is ongoing to improve on that. But we think that puts us in a quite a strong position from an operational gearing perspective for the future recovery, as well as future onboarding of new customers. And at year end, we also reported that we had a break-even point of 13.5 million. I'm pleased to say that we brought that down to more like 12 million based on the current overheads that we're looking at the moment, so and the latest margin that we've successfully achieved. So we feel, although a loss position, we feel like we're well placed for the future. From a cash and balance sheet perspective, again, we feel like we're in a relatively good position on this. So cash at bank at the moment is 3.5 million. The cash as at today is just over 4 million as a result of the post-period end Sybil's and finance facility agreed with Close Brothers that Andy mentioned. And we think that's really key. I mean, that's improved from the same period last year, and that's as a result of the 2 million NatWest Sybil's facility we've got in place, the Close Brothers facility, and a lot of work that's been done around working capital management, and in particular stock reduction. We've successfully reduced our stock levels 1.9 million when you take out the effect of stock provisions, 1.9 million from the same time last year, and that's helped us to maintain a kind of respectable net cash position of 1.1 million, excluding our property lease liabilities. So we think from a liquidity perspective, we're in a robust position, and the reason we've honed in on that so much over the last 6-12 months has been with an eye to that recovery being around the corner, and not a matter of if, but more a matter of when that might happen, and being prepared from a funding perspective to be able to afford that, and invest in our working capital when needed, when it arrives. So from an outlook perspective, just to summarise where we see things going, so at an adjusted EBITDA level, we think we will break even in the second half of this year. I think our key challenge as a management team is looking into FY22 at the moment and trying to get that run rate, that profitable run rate consistent and sustainable from FY22 onwards, and preparing the business for that recovery, as well as looking at the new customer pipeline and when they might come on board, given the upset that's happened in the sector. So I'll pass you back to John to summarise from that. Thank you.
Thanks, Chris. So as Chris said, to summarise, the sort of results of quite a challenging but optimistic year in terms of looking forward and trying to remember the world beyond COVID. We're starting to see a lot of cautious optimism, as we said. So really, the underlying business recontracting is a clear indication of our customers' continued need for us, the value that the service that we bring, and the developments in that service moving forward is a strong contributor for their recovery and the wider sort of industry recovery as the rates recover. The technology that we developed in-house and the operational changes that we've made from the sort of utilising that technology has improved our break-even point, which again, that journey continues, and we will continue to drive that as the technology gives us the information to make those decisions. The gearing's there ready for the recovery, and I think we're in a good place to benefit when that starts to bite, and underpinned with the liquidity position that Chris has just taken us through there, means that we can, having managed the storm, we can also manage the recovery as further cash is needed for the recovery and material stocks and the sort of general sort of return to higher rates. Yes, the short-term volumes are impacted, as we talked about, but this is a long-term industry. Velocity has plans to be a very long-term partner to our customers. We're at the front end of the process. We're at the the critical end to get right in terms of the pay setter for the whole aerostructures manufacturing piece, and the technology that developments that we've made really helping us to improve our own internal position and that of our customers, and also a more compelling proposition to newer customers as they too look to recover back from the effects of COVID. The challenge, obviously, and the expectation from ourselves is to get back to that break-even position in this second half, while still in this uncertain, challenging market. But we're confident that if everything continues along the lines that we're seeing, that is more than achievable. And we are starting to see first signs of that low rate recovery. Hopefully that's going to continue over the summer as the lockdowns and the restrictions release, as we are allowed to go out and visit customers again. That will could be a very strong and compounded benefit to everyone, and allow us to get back into those pre-COVID levels, and capitalise on what is still a very large and significant industry in the world. I think from our point of view, that covers the presentation. Thanks everyone for joining us this afternoon. We obviously take questions. Andy's going to take a lead on those, and also there's a lot more information on our investor part of the section of our website, velocity-composites.com.
John, that's thank you very much indeed, Andy, John, Chris. Thank you very much indeed for updating investors today. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via Investor Dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the company can better understand your views and expectations. Andy, if I may, we have had some questions come through from investors on today's presentation. Where appropriate, could I ask you to read out the question and either give your response or pass it to a member of the team? That would be great.
Great, thanks. So the first question is from Andy M, and his question is around the sales process and how we work through that process, which actually we have a slide on that, which is slide 14. And the second part of his question is then, well, what visibility do we have on our sales revenues going forward? He's put in a normalized world. I'll just answer that second part while John moves to the slide 14, because I think it would be good for you to just have a very brief chat on that. The second part is, because we're contracted, we work with customers, they provide us their forecasts, we plan ahead, that we have quite a good visibility and we are fully contracted on those sales. So we know, for example, that our underlying base level of sales on those key contracts at the moment is 8 million, which we've talked about. And then we know on top of that, there is additional requirements and sales. So we have a good visibility of 80 to 90% of what we're going to see in the next 6 months. We have security over the vast majority of our sales. The issue there does become the volume side. And at the moment, what we're seeing is, if anything, customers are slowly starting to upgrade that versus earlier forecasts. But we will see before they are reported, and if volumes are going to increase significantly, we will see that. But it will be probably underpinned by rate increases by the OEMs, which are Airbus and Boeing. So, for example, a run rate to look out for would be the A350 with Airbus, which is a high composite twin aisle plane. I'll pass you to John just to give a couple of minutes just on the sale process, given that was one of the questions.
Thanks, Andy. So, I mean, as you can imagine, in such a regulated industry, there's a lot of process to onboarding new customers. Thankfully, when we used to fly, that was obviously something that's very important. So, as part of that, we have to also work with customers who, I think, it's fair for them, and I'm sure they would agree, then, that some of these processes that they have internally aren't necessarily controlled from a financial perspective. They sit in overheads, they sit in different parts of their operational organization. So to actually break out what their current cost is can be a little bit time consuming, and a sort of a one-off process. So this is where we sort of really get involved in that process. So if we take the flow chart as is, there's obviously the initial engagement where we're sort of working with new customers and explaining who we are, what we do, our track record, where we do it elsewhere, and how we think we can help them. To actually put a bid together, we need some data. So then there's this phase really of getting that data out of them, of their the products that they require and how they do it in-house, developing the solution with our engineering teams, and really formulating all that into a very, very detailed bid with essentially an individual price per kit, and sort of comparing that to their current state. And then we enter this red phase, and this is where it can take quite a bit of time and effort from us to really work with the customer to help them understand their current state, show them the future state, show them how we achieve that in a way that doesn't bring any additional risk to the process. As we said a minute ago, this is the first part of the process. You've got long lead times on materials if things aren't done correctly, and which makes it very difficult to correct. And again, our processes, our technology means that we can manage that. We just need to show the customers how we'd manage it, and develop these condition of supply documents, these quality plan, the transfer plan, the commercial agreements. Just work all that through from really a position of nothing to a very, very detailed project plan to launch the outsourcing activity of the customers. When we get the customer decision, it then moves into a much more straightforward phase with our new product introduction teams, if you like, the project managers, to really deliver that transfer, to manage the transition of the material supply chain from in-house to external, to use up their existing WIP, and to implement all those agreements that have been created in that first phase, and actually move to sustained delivery. So I think in summary, the process in the blue areas works very well because it's pretty much led by us. What can take a bit of time is the red areas, where we're really dependent on customers to understand their current state, actually determine what the current state is and, extract all that information out of overheads and to do a very detailed business case that can, obviously withstand scrutiny. And that's, where we're getting a lot more involved in now. And, I think we talked about it at the sort of year end and the half year previous, where, the new commercial offering was for us to get very much embedded into that business case and almost create it without looking like we're marking our own homework. So a lot of work's gone into that. A lot of, really good processes have been developed by the team. It's just, again, been hindered by COVID in terms of not being able to travel, visit sites and actually get in front of customers and discuss that hard data and show them what the future state could be.
Thanks, John. The next question is from Simon C, and it's about our license model and whether that could be a driver for growth overseas. So I'll answer that one. Yes, we actually developed the model very much thinking about a more simpler, effective way and lower cost way to expand overseas without having to build brand new factories. And that was this hybrid model of actually working within the customers' factories themselves, a combination of different ways of us setting up within the factory, and it's really dependent on whether we buy and sell the material directly or we just use our technology to process the materials, and the customer continues to do the buying of the material direct themselves. Also, there is the issue of do we put new employees into a factory or overseas, or does the customer provide the labour support there? But we measure the benefits that our technology is providing, and then we share those benefits in a model which has a fee attached. And so we did do all that for overseas expansion, particularly in the States, and expect there will be that hybrid model utilised there. But in fact, what we found is it was also very compelling for in the UK for new customers, particularly, as I said, in the defence sector, where they are much more protective of their supply chain. So that has become the first customer for us to change the way that we operate in terms of how we charge and value our services. And in some ways that it's an easier way to trial that technology with someone who's very close by. But we certainly see this as a growth opportunity. So for example, customers that are in the UK where they utilise our full production facilities today but have overseas operations, we would look to say, well, why not use this technology within your factories elsewhere where we don't have a presence, following one of these license models. And just to cover on that, in putting that model together, we've partnered with Zund, who are one of the key hardware providers into our factory, and there's been a very good article with them recently in the press where they've talked about that partnership. Reason Chris has been working with Close Brothers is to provide asset financing if we are going to put kit into the factories that which is fully programmed with our technology, so that it can be fully funded, and we can turn that into charging for a service which includes actually the cost of capital involved in that. And we've worked closely with software developers, and we continue to partner with them as well. The next, another question is on share-based payments, and simply noting that we have some share-based payment charges in the accounts. They relate mainly to historic share options that were given pre-pandemic, and they also relate to the fact that the board and senior management have sacrificed 20% of their salary for share options, which haven't been drawn down or used in any way. What we haven't done is bought any shares in the marketplace, so there's been no cash cost to us in those share-based payments. Another question is really, is the board more stabilised now, or has stabilised after issues several years ago? Absolutely. We've rebuilt the board, we've rebuilt the senior management team, we work together very closely, and I think the fact that we've managed this situation so effectively is testament to that. And I think we've hopefully you can see that we're coming out of this very confident, despite the challenges that we've had. And another question was just clarification: is the 12 million break-even point? What is that? That is sales revenue, top line revenue is where Chris had worked out the current break-even point is. I have to say, I think that could fall further, because if the margin increases, particularly on new business, then the break-even point actually falls further in the business going forward. So, but it's fallen from 17, 18, 19 million down to 13 million, down to 12 million, and I think that it's more likely to fall further than increase, in the next 12 months. But hopefully that answers that question as well. I think that in doing that, I've answered all the questions as well.
Sorry, Andy, just to add on that, because I think the question asked around operating profit. So it was adjusted EBITDA I was referring to when we talk about break even,
okay,
which is what we use internally as a measure of our performance, profitability, and cash generation. So just to clarify on that bit.
Yeah, so it's profit before depreciation.
Yeah.
And
thank you. I think you actually there have covered them all off, as you say, Andy. You have covered off all the questions. If we do have any further questions in at all from investors today, the company do have the ability to review these post the event, and of course we'll publish all responses back on the Investor Meet Company platform. John, perhaps before I could direct investors to give you some feedback, I may ask you just a few final words just to wrap up, please.
Once again, thanks everyone for joining us this afternoon. Hopefully we've covered off the key points and given you a flavour for the work that's gone on of the previous 6 months, and how that sets us up in the coming 6 months and beyond as we look to enter the recovery phase in our industry. And as we say, any further questions, please don't hesitate to get in touch.
That's fantastic. Thank you very much indeed. Andy, John, Christopher, thank you very much indeed for updating investors today. Could I please ask investors not to close the session? It should be automatically redirected for your opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete and be greatly valued by the company. On behalf of the management team of Velocity Composites PLC, we'd like to thank you for attending today's presentation. That concludes today's session.